This is Money Talks. I'm Greg Vogel, Portfolio Manager at GKV Capital Management. It's a new year, and although we're still dealing with the COVID pandemic in our everyday lives, the capital markets have mostly moved on. We talk a lot about how the stock market's forward-looking. From an academic standpoint, stock prices are fundamentally based on future cash flows. The value of a company is more dependent on what its cash flows will be next year and the 5 years after that than they are this year's. Normally, weak earnings or a loss in the short term is a bad sign. There's usually not a great reason to assume that things will dramatically turn around in the future if a company is struggling. If this year's bad, frequently next year will also be negative. In the case of the pandemic, the calculus is a little different. At the outset, in 2020, investors sold rapidly, not having any idea how substantial or how long the initial economic shutdown would last. The prospect of massive unemployment and significant bankruptcies was not far-fetched. In periods of uncertainty, the safest course of action is to go to cash. When the government backstopped the economy with stimulus and the rate of new COVID infections began to slow, it was possible to forecast a rebound. Corporate earnings jumped 60% last year over the depressed level of 2020. The stock market moved higher along with those earnings. In fact, the market has been anticipating this growth since mid-2020. So while the pandemic drags on, the economic impact has largely passed. Corporate earnings are higher than they were back 2 years ago when we were just starting to hear about COVID, and the stock market is now higher as well. So where do we go from here? The big gains in earnings coming from the reopening of the economy and pent-up retail demand have occurred. We will still see some solid gains this year, but instead of 60% earnings growth, the forecast is for 9% earnings growth. We've shown this chart before, but here's the latest version. Corporate earnings for each year since 1988 and the value of the S&P 500 index. Earnings grow, driving the value of the stock market higher. The point here is that earnings growth is necessarily slowing to a more normalized rate. And with that normalization, we expect returns for stocks at more typical levels as well. 7% or 8% is generally a good year for equities. There's still quite a bit of economic disruption due to COVID. Travel and many leisure activities still haven't fully returned to normal. Some companies that haven't had an opportunity to bounce back are still trading at prices that assume things won't get back to normal for a long time. We believe they will, but it's going to take some time. The pandemic encouraged many investors to pile into the same companies. Many of these appear overpriced now relative to likely future earnings. They might be good companies, but they'll have a tough time generating enough profit to justify their outsized stock prices. There are also quite a few companies that have been neglected by investors and are trading at attractive valuations relative to their earnings. We suspect that as the dust continues to settle, the spread between these two will narrow. The market today, despite the rapid spread of Omicron, is not particularly concerned with COVID. Disruptions due to workers calling in sick will affect earnings in some industries, but broad shutdowns are no longer in the cards. People are learning to live with COVID. Recently, there's been more concern around the sudden rise in inflation and what that means for the Federal Reserve and interest rates. The last period of persistent inflation in the U.S. ended in 1982. It was a long time ago, but painful enough that the prospect of runaway inflation is a scary proposition. To rein in inflation, the Federal Reserve had to reduce the money supply and raise interest rates substantially. It had to force a recession that resulted in 10% unemployment. Here's a chart of U.S. inflation going back to 1970. You can see we're a far cry from the crippling inflation rates that peaked in 1980, but the sudden rise is raising alarms. To rein in inflation, higher interest rates will be necessary in 2022. Rates are still at historic lows, but we think the 10-year Treasury will end this year a bit above 2%. Higher interest rates does cool economic activity. Money for loans becomes more expensive, for example, which affects everything from housing to car sales. The recent spike in inflation is mostly due to supply chain disruptions, coupled with pent-up demand as we exit the pandemic. Unemployment has declined back below 4%. Workers are looking for better jobs, and with few workers available, companies are paying more. It's possible that inflation growth that started due to supply chain issues transitions into something more problematic. So we anticipate modest rate increases this year, getting to a more normalized interest rate environment. The transition to a more normal level will create some volatility in the stock market, and it will also put some pressure on bonds in particular. Here's a chart of the yield of the 10-year Treasury bond. We're still at historic low levels at 1.73%. If the rate of inflation stabilizes and supply chain issues work themselves out, it won't be necessary to cool economic growth very much. But if inflation gets out of hand, then the Federal Reserve will have to pump the brakes, which will affect economic growth and long-term earnings significantly. Good companies, assuming they aren't too expensive relative to their earnings prospects into 2023, will continue to do well. A modest increase in interest rates should not be alarming, but this is why investors are nervous, and it's one of the potential risk factors going into the new year. We do expect the equity markets to move higher this year, and we expect the S&P 500 will increase in line with those earnings growth. For more detail on our analysis, you can download our quarterly update from our website at gkvcapital.com. You can also sign up for our email distribution list to receive our reports in your inbox. Thank you for watching.